Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. And what a week this has been for commodities as an asset class. With geopolitical risks lingering, the crude oil prices have seen an upswing in this week, with Brent up by nearly 8% and well above the $70 per barrel, forcing a debate on whether $70 is a new norm for the crude prices. This is also a week where the crude prices are headed for the biggest weekly gain since the month of July. But moving on to the metal space, and it was all about aluminum in this week after the U.S. imposed sanctions on Russia's UC Rusal. Rusal is the second largest producer of aluminum, and that has led to a deficit of a whopping 8 lakh tons of aluminum in the global markets. This has helped the aluminum prices to hit a 6-year highs today. LME aluminum prices have seen the biggest weekly gain in over 38 years, and we have the prices nearly 15% up in this week. Moving on to the precious metals, and it has been a good week for them as well, with the gold prices headed for a second week of gain as concerns in Syria have added to a safe haven buying here. Palladium prices are headed for a biggest weekly gain as well since the month of October. And joining us to discuss all of those commodities now is Christopher Main, who is VP of Oil and Gas Analyst at Citi. Also joining us is David Lennox from Fat Profits. Gentlemen, hi. Thank you so much for joining us. David, let's start with you. And I would want to talk about the crude oil prices first. We are holding above 8 to 9% for both the crude varieties. It is a strong weekly gain. $70 has held every single day in this week. What is your sense on where are we headed now for that?
Well, look, there's no doubt that one of the reasons we've seen such a strong oil price over the last few trading days is the fact that the Saudis did announce that they did intercept a Houthi missile over Riyadh. So that unfortunately brought the markets into some concern when they looked at where that missile was supposedly intercepted. And it could mean that Saudi's oil fields could come into range should the Houthis have considerably more of these particular types of missiles. So we've seen that reaction quite quickly come into the price. And that was on top of the fact that we did see out over the Thursday trading evening a very, I guess, poor figure coming out of the EIA in terms of the inventory numbers in the US and, of course, domestic production inside the US, which did rise by about 20,000 barrels over the week. So given that poor news, the oil price has reacted quite savagely to the Riyadh and Saudi news on the international the interception of a missile.
So while in the back of all of those fundamentals then, David, are we holding 70? Are you looking at 80 and beyond kind of levels now coming in for the crude oil prices? Or would you say much of the international uncertainty by now has been factored in?
Look, certainly we think that if it is a geopolitical, that we have seen the Houthis firing missiles into Saudi Arabia sort of spasmodically. So we would need to see an escalation of that event happening, i.e. we would need to see perhaps further missiles being fired, unfortunately. And that would, we think, confirm the Brent price well above $70 in the near term. If, in fact, it is just a spasmodic firing, as we've seen before, then we think that geopolitical tension will ease. Markets will become less concerned that the Saudi oil fields will be able to be hit, and that means that we will see that premium come out of the oil price. At this point, we would suggest that perhaps the oil fields will remain safe, and we will see the oil price drifting back below the $70 range for Brent in the not-too-distant future. However, just going forward, Manish, we do think that we're coming very soon into the northern summer, and we do expect to see a very strong demand coming out of the northern hemisphere for oil. And that, we believe, will be the real sustainable push that we're going to see in the oil prices in the not-too-distant weeks.
Oh, well, absolutely. It doesn't end, does it? Because there's just so much to watch out for. But getting Chris into the conversation as well. And Chris, hi. How do you see the week gone by with nearly 8 to 9% gains, a new 2014 highs for the crude oil prices? As we step into the new week, would you say that all of these uncertainties, concerns, geopolitical risks would just continue to play on? Has that been factored in, or are you looking at further highs in prices from here?
Yeah, I think it's a good point. It's been a pretty strong week for oil. The issue is that all of these geopolitical disruptions, be they Iran, Latin America, Syria, maybe even Russia, they're not actually affecting any physical oil supplies at the moment. So, yeah, for now, we could see prices stay supported or even make new highs, as you referenced. But unless there's actually a material disruption to oil supplies, which there hasn't been, then it means further down the line that you could see prices correct lower to where fundamentals probably imply them to be.
Chris, plenty has been talked about crude oil in this week as well. You have OPEC and the IEA monthly reports as well, where both of these are talking about on how the global inventories have come down quite sharply and how the demand scenario seems strong, especially with the China imports, the second highest on record in the month of March. How bullish are all of these fundamentals?
They're bullish to a degree. The thing that makes them perhaps less bullish is that OPEC themselves have said that they're targeting inventory levels and getting inventories back to a more normal level. So if we're approaching these 5-year average or 7-year average levels quicker than the market expects, then this perhaps raises the spectre that we see a return of Saudi or other OPEC production perhaps sooner than the market is currently pricing. So again, it's the same as geopolitics. For now, it remains bullish and remains constructive, but what it could do is it could bring some of the more bearish themes in the market to play quicker.
So, Chris, what is your sense on a quarter-on-quarter basis? Where do you see the crude oil prices now behaving as?
So broadly, I think we'll stay supportive in terms of the crude price through the summer. The summer fundamentals are pretty robust, and you layer in the geopolitical risk elements that you've talked about. But going into the end of this year and definitely into 2019, we do think that you could see a sharp correction lower in outright oil prices, specifically in the US as well, where there's a lot of production coming online.
So any range that you would want to come out with? I mean, are you looking at prices reaching below 60, going up to 50? Because there is a divergence when you look at experts talking about the crude oil prices. There are reports which suggest a $50 per barrel in the second half, and then there are about 80 as well.
Yeah, I think in the summer is when you could stay. I don't think you're going to have a correction lower in the summer, but I think definitely by the end of the year or into 2019, you'll see Brent prices back below $60 again, so into that 50 range. But yeah, for now, this flurry of geopolitical events is really proving to be supportive for the price.
About the geopolitical events itself, Chris, what is your sense? Because we are, of course, looking at this whole import tariffs, and that has impacted crude. We've seen sanctions from U.S. on Russia, proposed sanctions on Iran, the whole Syria geopolitical concerns. We've seen the gold prices take some support from that too. So how much of an impact would you see of the global factors on crude, and how have you seen that impacting other commodities as well?
Yes, it's a good point. I think on the crude-specific element, it's crude is the biggest commodity in terms of trading volumes, and it's probably the one most associated with risks in the Middle East. So even though right now we're not seeing any disruption to the supply side, the potential risks arising from Iran, some spillover from Syria, something related to Russia, something related to sanctions, where we are actually seeing more meaningful price rises or more fundamentally driven ones is commodities such as aluminium, given the step up in U.S. in Russia tensions. So across the metal space, you've seen definitely support there, and I'd say that's perhaps more fundamentally warranted than the oil price that's more of a knee-jerk shock reaction.
Oh, absolutely. Since you have mentioned about aluminum, how are you looking at that? I mean, suddenly we are staring at a deficit. We also are looking at the prices up by 15%, the best weekly gain in 38 years. How do you look at a commodity that behaves like that? Is it knee-jerk? Will it settle down? Or are you looking at much further gains from here? Aluminum, by the way, is trading at a fresh 6-year highs as we speak.
I mean, coming into the year, we were supportive on aluminium on the kind of as you say, a deficit market. The fundamentals were good, and particularly going into the summer, we expect the broader macroeconomic picture to improve in China as well. So that would prove supportive. And then we've had the two recent announcements of the imposition of tariffs on China and the potential for a trade war there, and then also the move from the US against Russia that's proved very supportive. So again, I think for aluminium we remain constructive, and these geopolitical events have just added to the constructive backdrop, and you've seen it kind of across the commodity landscape where there's been tight supply-demand fundamentals and they've been added to by geopolitics.
David, would want to get you back in the conversation. What is your sense on the metal prices really? Because on one side, we have seen the aluminum prices run up and about. And on the other side, it is the zinc prices, which are actually closing the week nearly 5% on the weaker side. So would you say that the whole metal sector has stopped moving as a sector, and we really are looking at individual fundamentals, each one on its own here?
Look, certainly if you have a look at aluminium, it's like oil, it's reacting to geopolitical events. Obviously with the US coming out and placing sanctions on Rusal, they produce 3.9 million tonnes of aluminium, of which 400,000 goes into the US. That means automatically that US customers are going to be looking for about 400,000 tonnes more aluminium. That's something that the market can easily digest. But the concern the investors and traders are having is around the ripple effect that we may see. Certainly at this point, the sanctions are only applied to Rusal, but we may see if other countries happen to join in with the US, we may see that other Russian producers of commodities are going to be dragged in as well. We saw a reaction in the nickel price as well as the aluminium price. So really it is very much a watch this space. Aluminium, certainly with its fundamentals, we wouldn't be seeing the strong rally that we've seen in the price at the moment. Yes, it has had quite a firm run, but it's been that geopolitical that's driving the price just that much further on the upside. In terms of zinc, it's had a very, very good run on the back of a supply-demand deficit, and we think that that certainly remains in place. We wouldn't be shorting zinc at this stage. We think, yes, a pullback will come as traders take profits, but you wouldn't want to hold those positions for very long. You'd be looking to continue to be long, especially going into the very busy northern summer.
Well, absolutely. That's what our experts are telling us, that crude prices, of course, as of now reacting to geopolitics, but can come under some pressure as we move forward in the day. Gentlemen, stay on with us because we will be talking a whole host of metal prices after this break. But before we head this break, let's also listen in to the president of Saudi Aramco on the investments in the crude sector and the road ahead for the crude prices as well.
Well, there is a healthy growth in the market in terms of demand. We have seen, if you look at the IEA or the EIA, in terms of the demand growth, for the last 3 years, you're looking at between 1.5 and 1.6 million barrels. So for 3 years, the demand growth is around 5 million barrels per day. And of course, there is a lot of talk about transformation, which is happening in terms of renewables, electric vehicles, and that is taking place definitely, but it is starting from a low base. Even though there is a lot of capital being injected to bring additional shale oil, the decline rate in shale oil is very significant. You're talking about a decline of 70% in the first year. What you need is more conventional oil with a better plateau. You see, the difference is that you need a more sustained plateau, so the decline will not happen. It will take some time before the decline will happen. And that type of investment require significant capital and also require significant time to bring it on stream.